Hey everyone, welcome back to Corporate Decoder. Today, FNRN just filed its quarterly report, and I am seeing some interesting trends in their banking business. Quick note, this is not financial advice, just my take on public filings for educational purposes. Their latest report shows a mixed bag of results, with some areas growing and others facing pressure. So let's dive into what the numbers actually mean. Looking at their income statement for the 3 months ending in June 2026, net income was about $4.7 million. That is down from about $5.5 million in the same period last year. For the first 6 months of the year, net income was better, reaching over $10.6 million, which is up from about $9.1 million last year. So the first half of the year looks good. But the most recent quarter saw a dip. This drop in net income also shows up in their earnings per S-Hair. For the 3 months ending the 30th of June 2026, diluted earnings per S-Hair were 29 cents, down from 33 cents a year ago. However, for the first 6 months, earnings per S-Hair were 64 cents, up from 55 cents last year. So again, a strong first half, but a weaker second quarter. Now, let's talk about how banks make money. It is mostly through net interest income, which is the difference between what they earn on loans and investments and what they pay on deposits. For the first 6 months of 2026, net interest income was $34.2 million, up about 4% from last year, but for the 3 months ending in June, it was pretty flat, just slightly up to $17 million. This indicates that while their overall business is growing in this area, the recent quarter saw less of a boost. This is the money banks set aside to cover potential losses from loans that might not get paid back. For the first 6 months of 2026, they set aside $900,000 for this, which is a bit more than the $850,000 last year. But in the most recent 3-month period, they set aside $600,000 compared to nothing a year ago. This increase suggests they might be a bit more cautious about the economy or the quality of their loans right now. Looking at their balance sheet, total assets grew slightly to $1.93 billion by the end of June 2026, up from $1.91 billion at the end of 2025. Their loans, which are a big part of what banks do, also grew. Net loans were about $1.09 billion, up 4% from the end of 2025. This growth in loans is a positive sign for a bank. On the other side of the balance sheet, their deposits, which is where they get their money to lend out, also grew a little, reaching $1.69 billion. This increase is good because it means customers are trusting them with their money. Their investment securities also saw a small increase, reaching $618.9 million. This is important because these are investments they hold to manage risk and earn extra income. Let's look closer at their allowance for credit losses. This table shows how they moved money around to cover potential loan losses. For the 6 months ending the 30th of June 2026, they added $950,000 to this fund. This is a significant amount and reinforces the idea that they are being more careful. Now, about the loans that might be having trouble. Non-accrual loans, meaning loans where they've stopped expecting interest payments, were about $4.6 million at the end of June 2026. That is down from about $6 million at the end of 2025. This is a good sign because it means fewer loans are in serious trouble. This is property the bank has taken back, usually because the borrower couldn't pay their loan. They had $1.2 million in this category, which stayed the same from the end of 2025. This is a neutral number, not great, but not terrible. When it comes to paying their employees, especially top executives, they use stock options and restricted stock. For the 3 months ending the 30th of June 2026, they reported about $271,000 in stock-based compensation. For the first 6 months, it was around $271,000 as well. This is a normal part of how companies attract and keep talent. They also have an employee stock purchase plan. This allows employees to buy the company's stock, often at a discount. They reported about $31,000 in unrecognized compensation costs related to this plan. This shows they are trying to give their employees a stake in the company's success. This is a bit technical. It is a way to track unrealized gains and losses on certain investments. For the 3 months ending the 30th of June 2026, they had a loss of about $1.3 million in this area. For the first 6 months, the loss was about $4.4 million. This reflects market fluctuations impacting the value of their investments. Looking back at earnings per S-Hair for the first 6 months of 2026, it was 66 cents, up from 56 cents last year. This is a solid improvement. Diluted earnings per share also saw an improvement for the 6-month period, going from 55 cents to 64 cents. This means that even if all potential shares were counted, earnings would still look better. The company's total assets grew slightly to $1.93 billion, while its total deposits also saw a modest increase to $1.69 billion. This indicates stable growth in their core banking operations. The net interest margin, which shows how effectively they are earning from their loans and investments compared to their interest expenses, was 3.79% for the first 6 months of 2026. That is a small increase from 3.74% last year. However, for the most recent quarter, it was 3.75%, down slightly from 3.85% a year ago. This again points to that slight weakening in the most recent 3-month period. Non-interest income, which includes things like service fees and brokerage income, was up significantly. For the 6 months, it jumped to $3.5 million from $3 million last year. For the quarter, it was up to $1.76 million from $1.54 million. A big part of this increase came from their investment and brokerage services, likely due to acquiring new clients. Non-interest expenses, which include things like salaries, rent, and technology, were up for both periods. For the 6 months, they went up 2.2% to $23 million, driven by more employees and higher technology costs. For the quarter, they went up almost 10% to $11.9 million, also due to more employees and higher consulting fees. This filing comes after some news that highlighted a drop in net income for the second quarter. My analysis shows that while the overall 6-month picture is positive, that recent quarterly dip in net income and margin is something to keep an eye on. The increased provision for credit losses also signals a more cautious outlook. Overall, First Northern Community Bancorp seems to be navigating a mixed economic environment. They are growing their loan book, and deposits and non-interest income is a bright spot. However, that dip in the recent quarter's net income and margin, along with a more cautious approach to loan losses, suggests there might be some headwinds ahead. The risk I am watching is whether that slight dip in the last quarter is a blip or the start of a trend. Oh, and the research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded. If you found this helpful, please like, subscribe, and join our Discord community linked below.